Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, July 14th. We're lucky today. We have Patty Healy, head of our credit
Hello.
research effort, and we're going to pick her brain about the bond market and how it reacted to some of the numbers this week, inflation-wise. So quickly on the equity side, another strong week. Thought we might be running out of gas a week or two ago. I've been off mark there, certainly. Good strength out of technology. Banks so-so today in that initial round of Q2 earnings. It's going to get busy the next 2 or 3, 4 weeks. The only concern I have is have some of the sectors and stocks run up into good earnings. Sometimes I like to see weak pricing, weak action before earnings so that earnings can pull you up a little bit. We'll see. A lot expected out of these numbers. Last quarter, not much expected. So we'll see what happens. We'll have some reasonable swings. Patty, first time in a while that I felt like there was some real progress being made on the inflation front this week. CPI, PPI numbers, pretty good.
Right.
What are your thoughts?
Well, both the CPI and the PPI, they're the actual numbers that came in were below expectations, so that's always good. And that includes month over month and year over year, and it excludes ex-food and energy, which is like a volatile component. So as John Musso mentioned last week, we might see some higher prints going forward because it's going to be compared to a lower inflation rate last year at this time or next year, next month. So just it's going to be a bit wobbling around there on the inflation numbers.
Two steps forward, one step back, but the trend has been solid.
But it's definitely on its way down. And some of the other economic numbers have been a little mixed. Like, last week the non-farm payrolls was like a mess and completely different than the ADP. And then initial jobless claims are now lower, and things are getting revised, and the bond market seems to be going up and down, and people's expectations of what type of recession we might have, a soft landing, hard landing, no recession, and what the Fed might do is also on everyone's mind. And so the next FOMC meeting is on July 26th, and they're definitely expected to raise interest rates about 25 basis points. And then we'll see what happens with the numbers that come up in the next couple of weeks, I think.
We'll see. Let's give the viewers some inside baseball. Okay. I know every Friday the bond team meets to go over next week's schedule, where bonds can fit, where's cash to be allocated. What did you talk about today in the meeting?
Well, we call it our calendar call. And every Friday morning, all the broker-dealers finally figure out what deals they're going to bring to market. We could figure it out over the prior 2 weeks, but really, you never know which deal is really going to be coming to market. And by Friday, we also have an idea of new accounts that might have come in, or calls, or maturities, or what have you, and what our cash, as you said, the cash run.
Right.
And so our credit people, our portfolio managers, and traders sit together and we discuss the different credits. This week, there happens to be a lot of PSF, or Permanent School Fund. It's Texas-related, insuring school districts, but we already have a lot of that paper, so we're looking at other things to get out of.
The calendar seems like it's building a little bit versus a month or two ago.
Yeah, it seems to be building somewhat, for sure. Especially in the holidays and the early months, and when people really didn't know what to do. It may be one of two things. They weren't issuing as much before, and now they're starting to issue more, and maybe people are saying, well, we better raise money now. We don't know where rates are going, but it's time to raise money. Also, there's like maturities and interest payments are fairly large in July and also in August. So there's going to be demand for that paper.
Cash coming into accounts because of the maturities, because of coupon payments.
Right. The other thing I'll just mention on the calendar call, which I think is interesting, traders are saying, oh, this is a great bond, this is a great bond, this is a great bond. I'm like, well, do we have that much cash for all these bonds? Because it's like over $7 billion and that's coming. And they're like, well, we'll only do it if we can increase the coupon or the book yield. We're not going to trade just to go buy a new deal. That's good. So we're really taking a hard look at the portfolios and the structures and things.
Great point. I get calls from clients, and sometimes they're asking, hey, why did you sell this bond? Let's say it's a Texas muni bond, because you just mentioned Texas. The reason we sell a bond is we feel that capital can be replaced by a bond with either higher yield structure or a better credit rating. We're trying to always upgrade portfolios, and that's important when there is any kind of chaos in the bond market. You want the strongest bonds in your portfolio, not just because they tend to price better and hang in there better, but if you had to sell them, there's a better bid for a higher credit or a more liquid bond. So that's you gave me a little entree there, because I got a couple calls this week about bonds we sold, but we know that they're going into new issues that we are reallocating from last week.
Right.
I saw some bonds last week float by my desk, 4.5%, 4.75%, 5% on a tax-free basis. Remember, tax-free bonds have something called a taxable equivalent that's important for all of us to understand. You know, a 5% or a 4.80 or a 4.70 tax-free municipal bond is really netting an awful lot of our clients and holders a 7.5 taxable equivalent. These are very attractive.
Yeah, depending on what states
bonds.
they're in.
Right.
High tax states, it makes a big difference.
Sure,
So,
sure.
yeah. And then one other thing that you mentioned too was people wanting to invest in high, really short-term yields and money market funds, and versus going out longer. Like, why would you go out with all that risk and stuff? But at Cumberland, we do use very high-quality bonds, the AA's and AAA's for the most part, and we have a barbell structure. So we're buying some short-term paper and some longer-term paper, and that shorter-term paper leaves us room to maybe invest when we find a good opportunity in the longer end at the higher yield. So that's
yeah, I like how we're positioned in this market, and I certainly am confident, and it's just my opinion, I'm certainly confident that these 4.5%, 5% tax-free yields are going to hold up as inflation sinks.
So you got to remember too, there's a difference between, for listeners and what have you, 5% is the desired coupon currently. So a muni bond could have a 5% coupon. You might pay more than par for it because the level of interest rates, well, it is close to 5%. It's gone down a little bit, but still it's gyrating around, high fours and stuff. So
yeah. Well, that's great. Great information. Thank you, Patty.
Thank you. Good to see you again. Good to see all you guys again as well.
Enjoy the weekend. We'll see you next Friday.